Hey, Daniel.
Hey, Mike, how you doing?
You know, I think I'm doing all right. How about yourself, man?
I'm enjoying this beautiful sunny day. It's our mid-year planning meeting, so it's been really nice to be able to talk about some important things, but also be able to relax and enjoy this beautiful day. So.
Yeah, I couldn't agree with you more. I actually see you have a fine chair there, and yours
Right.
there. Mine, I did not gain that much weight that I'm deflating it, but it is the chair. But I am still enjoying it none the same. I'm going to end up in the pool later today.
Very good.
So-
Well, I appreciate you. The nice chair.
I kept it for you. So what's new and exciting? How's your week been?
You know, it's been really good. I'm really excited that a lot of the new clients that I'm talking to are, you know, based on referrals from other clients that we have that are really happy with the service that we're providing. And, you know, that really is exciting and makes me feel good about the work that we're doing. So that's something that's been really good for me.
Yeah, actually, I think half of my meetings this week were with referrals, and one particularly was that, you know, a lot of times I think the clients try to pre-qualify, right? Say, oh, I want to find that person. I want you to hang out with my richest friend, or, you know, whatever, right? And that's not really what it's about. It's about the people that we can help the most, right? So this one was a young lady, you know, from a client's twice the age, you know, in a sense. Maybe I'll get myself in trouble with that one, but you know, they're much older, right? Different responsibilities, but her dad passed away, and they needed help, and no one was there to help, right? They're not, you know, quote unquote, your ideal client from your normal advisor, but they're an ideal Clark client, which is someone we can help, right? The idea of actually going out and saying, okay, how can impact, how can change stuff, how can we help their life, right? That's our ideal clients. Who can we impact? How can we help them? Don't have to pre-qualify them. Oh, do they have X, Y, Z? None of that matters. Can we help? Can we be of service, right? And that's why I think we have the multiple different types of services, because you know what, from the asset management to the financial planning to everything across the board, there's always somewhere we can typically get help. And if we can't, you know, we actually know how to say, hey, not right now, but here's when and here's why, right? And that's what's important. So that's awesome. You know, it's very, very exciting to see it. I think, as you said, we just went through, we're at our mid-year meeting and going through, and man, the amount of referrals that come in there. And that's something else for the clients that are sitting on the wall, that kind of how that idea is, that just know that, you know, part of our planning this year is as the world reopens, Clark reopens, right, in a sense, to this one. And a lot of you we've been to a lot of our private events and a lot of our stuff like that. And just know that be on the lookout in your emails for invites for client events for you guys to come to. We're not going to be doing, you know, client bring a friend events. You're going to see those. So if you start to think about those people that want to meet us, you know, or just get to know us, that's the way to do it, right? You'll see those coming on very shortly as we kind of wrap up the year, so in appreciation. We're also going to be working on, you know, a lot of people, I know Laura from our office talks to a lot of people about, hey, you know, our Referral Advocates Club. So if you referred people in the past, hey, there's going to be a special event for you. We just might, if we can get some more referrals this year from those people, right? Maybe you can sneak in for the 2021 plan, even though you didn't do it 2020, right? So we might be able to sneak you in if we get in there before the event. So if you want to get on the list, don't keep us a secret. If there's anybody that we can help, don't pre-qualify them. Just send them our way, and we promise we can help. You know, there's lots of things. Yeah. So from a planning standpoint, or from a client standpoint, anything unique that you've seen this or last few weeks or so?
You know, I've seen you know, a lot of talk about fees,
right?
And I know that's something that you wanted to cover. And you know, one thing about our firm and how we operate is, you know, there are a lot of advisory practices that they know how to bury fees very well.
Yep.
Right? They'll stuff your account with mutual funds, and a client has no idea what's coming out on the back end.
Yep.
Right? So there's not a level of transparency there. And something that we believe very strongly at Clark Financial is to be transparent about the fees. And you know, sometimes the client, they see that actual line item on their statement, and you know, it's a little difficult, right?
Yep.
Because they're used to it not seeing it, but just coming out of the back end.
Right.
So, you know, that's something I've been dealing with a lot, and just wondering if you could shed some light on that, because you have some good thoughts about it.
Yeah, I couldn't, you know, what I love is that kind of timing is key, right? And so I just had that conversation with a client actually yesterday. They came in, and their current mutual fund is, you know, their buried fees. And this is just their expense ratio. This isn't even the internal ask and bid. I was just educating one of our younger clients on that today was, well, what about commission-free trading? I'm like, well, there's always an ask and a bid, right? So the bid, which means the buyback was at market price, but the bid was an extra 3 cents, right? Well, okay, well, if you're a mutual fund and you buy a block of 10,000, right? Well, you're going to pay the 3 cents on the 10,000, right? right? And why is that not a fee? Because it's not part of your expense ratio, right? So that's something that I had to educate him about. But in this specific example was, our asset management fee on the account was $7,200 a year, right, on the account. Okay, well, it's a lot, but depends on what it is, right? But the mutual fund expense ratio, which is pretty funny, was 5,200. So the passive management, but he said, I never see that fee, right? And I said, well, and we talked about the transparency of it, right? And so that was one thing. But I said, yeah, now this is why we're going to build you your privately funded mutual fund, right? And that's what we're looking to do this one. And the same younger client that I spoke with earlier in the day was, if you're going to buy VOO or you're going to buy SPY and you're going to buy just an ETF, it's going to be passive. What are you getting for paying that fee, right? You're going to get passive, right? It's how do you blend it in a total portfolio and why you pay the fee, okay? But going back to this one client, when we looked at how we were positioning their assets and how we were going to manage them and the strategies we put in place, it was an extra $2,500 a year, $2,200 a year. And I said, at the end of the day, if the market returns back, because it will, right? We go back to where we were in March, right, of 2020. If we go back to, to 2009, 2008, the reality, the client would have lost over $300,000 in their current, investment structure. Where when we repositioned with our strategy, which is a little bit more expensive, our real liability was about half. Right. They would have lost half the money, right, where they were. And I said, hey, if I could put an extra $100,000 back in your account, would you pay me the $2,500 or the $2,200, right? That's the idea of the value of the advisor, right? It's not when all the markets go up. It has a lot more to do with how we protect the clients in the market down. And that was a big thing that I think was a big kind of aha moment when it came up there. So, okay, it's not an issue. Fees are never an issue, right? It's the value they're providing. And that's why, in my opinion, the mutual funds have to hide it because they're not creating much value. They're an 800 number, right? As opposed to calling up and talking directly to Laura or Michelle or Chris, just having the real people and having us go over the accounts and paying attention to what's going on. They're not just a number to us or a number of investors. They're the people they are, right? And I think that makes a big deal.
I mean, at the end of the day, our goal is to have our clients for life, right?
Yep.
To serve them for life. And in that goal, they're going to be market cycles.
Yep.
And we've been in this unprecedented period of essentially the longest bull market in U.S. stock market history.
Yeah.
So it tends to breed a level of complacency, right? And there's a lot of reasons why people are migrating towards, passive index funds, 401k contributions and stuff like that. But, it's crazy. If you started working in finance earlier than 10 years ago, you haven't experienced a bear market at all.
Yep, that's correct.
Right? And, you and I have been through, 2008. And,
2000.
It's hard. Well, me 2008. But, it's, 2020, it's hard for me to say it was a bear market.
Right.
Like, technically, yes, 20% down from the high.
We got a whole 14 days of that.
Right. But it rebounded so strong. I mean, that is not a bear market.
Correct. Yep.
And, our goal is, because of the longevity, right, is we're going to be managing our clients through market cycles. And that's where the value of the advisor really pays off, and when risk-adjusted return really starts to matter.
That's correct, yeah. And this is where, for clients, if you're watching this or you send it off to your friend, or if you want to dive deep into cumulative rate of return as opposed to average rate of return, that's something that needs to be in this, right? Because the reality is, and I've showed this and I know you do the same, is, it's not about how much you quote unquote says on your statement in a sense like your average rate of return. It's, I gave you X amount of money, it's worth Y amount of money. I spend Y, I don't spend average rate of return, I spend cumulative rate of return in retirement. And I think having the right plan is, if we go back to the old adage of market cycles every 5 years, right? There's a big downturn. That means a 30-year investor, which means anybody 65, retired, right? They go to 95, 5 more 2008s. How do you manage through those things? And I think that's stuff that's very, very important as we go through here. So,
and talking about, fees for an index ETF, that manager, their job is to mirror the index. That's why they're so cheap. Now, if they see a cliff coming, they have nowhere to go. They have to stay on the train because, honestly, they're not being compensated to do anything
but they're
else.
Also, they set the rules. They have no choice, right? They can see it and say they have no choice. That's sort of the deal with that one. So, I think another one that was interesting that came up, have you been dealing with anybody with this new rule, right? Because we go back to 2020, we basically missed the entire year with everything going on. And it's really, how are we starting to wrap your mind around this idea of like the Secure Act, right? And this idea that you no longer have beneficiary IRAs, you've got to now liquidate them over 10 years. So have you any thoughts around that? Because I got a pretty interesting case study I did this week. So just what are your thoughts add to that before I kind of bring it to light?
No, it's interesting. We've actually, I've actually had a lot of conversations with clients about that, they have what they need from a retirement income perspective. They got a chunk of money in a traditional IRA, and more likely than not, their beneficiaries are going to inherit this thing.
Yep.
And in a lot of cases, that could be during their beneficiaries' peak earning years.
Yep.
And they have to take those forced withdrawals from a traditional IRA that they inherit, and that could really, do some damage from a tax perspective.
Yeah.
So.
And that's where my mind's always been. And I couldn't agree with you more, right? Because as parents, as I think about this one, is that for as parents, we want our kids to do better than we did, right? But what is better, right? Is better mean more money, or is better mean quality of life, right? And this is what I mean by that, is that, so I was doing the analysis for clients, so they retained us to go through and say, okay, does it make sense to do Roth conversions? What's the break-even years? What does it look like? What is the advanced planning that your accountant won't do, and most advisors who work for firms or employees of firms, they're not allowed to do, right? But from my standpoint, I was able to do this for the client. Here's what was unique, and why financial planning doesn't just mean for the family, just for that person, it's family planning. Because what I dug into was the fact that dad was very successful, son is reasonably successful, right? But not financially successful the same way dad was, right? But he lives a good quality of life, okay? Because that's what we really want to think is, as my kids get older, I think about not just about what they're worth or how much money they're gonna make, but what lifestyle do they want. Well, here's what's interesting is that dad was a very successful engineer, right? Making $200,000 to $300,000 a year. Son's very successful in what he does, but very good life. He's making half the money. So dad took a tax deduction, right, on his IRA. He's at 22, 28, right, whatever the years progress. But son's never going to get to that effective rate. Dad wants to know if we start doing Roth conversions. Well, with dad's pension and dad's savings and all the family whole stuff, there's no way I can get him below 29. But as soon as I wait and I take it for where the son's kind of trajectory for his income, they're going to be taking those larger withdrawals only at 20 and 24. So there's an instant 8 to 10% rate of return just by actually letting that money compound over time. This is why intergenerational planning, this is why I'm so happy to have his son come to the meeting to even talk about what we're doing with that. Because it basically looked at the strategy and I said, there's no break even. Your break even's when you're 87. His health's not ideal. So I said, hey, let's just not do it, right? And he's like, okay, we're having it on and going back and forth. But you know what? When we started talking about his only child, they're in a lower tax bracket. Matter of fact, he's getting an instant 8% rate of return by not doing the conversion. Risk-free return, might I add. Now, longer tradition. So that was something else I thought was very, very interesting, is that looking at family planning, but not just the planning for that one, but intergenerational family planning, I think is very, very key to look at that.
Right. I mean, Roth conversions, they don't always work.
Right.
And that's why you can't consider any one factor in isolation in a financial plan.
Yep.
Right? And the planning software, what it does is it pulls all the different variables together.
Yeah.
Even Social Security.
Yep.
I've run some analysis where it makes sense for the client to take it much sooner.
Yeah.
Right? And it has to all be considered in the context of a broad financial plan, or if you look at it in isolation, you can make mistakes.
Yeah. I don't say you could. I think you typically will, right? Because, one thing feeds the other, right? And kind of that idea. So sometimes we'll do a controlled burn, eat up IRA assets early to drive down RMD because only 85% of your Social Security is going to be taxed. That moves intergeneration. So everybody's different, and that's the thing. I think the last thing, which I thought was interesting, was looking at some of this stuff, same type of client, RMD, is what can we do, right, when you start thinking about how to reduce tax. So one of the things is my kids, we're thinking about 529 plans. And state of Virginia, most states, right, you're allowed to do this, your tax deduction. What's interesting is, state of Virginia, it's $4,000 per child, per parent. So I was just talking to my accountant about this. I have a $25,000 deduction that I can make every single year off the state of Virginia. Or 24. It's 4,000 per, right? $4,000 for Kayla, $4,000 for Joshua, $4,000 for Sasha, for me, and same thing for my wife. She gets the same deductions, right? For money we're going to spend anyway.
Right.
Right? And so that can also go with preparatory schools, right? Anything else like pre-college, right? So that's a big deal. But same thing with Grandpa in that case. He's got this RMD. We're trying to save taxes. Well, hey, if we can save 5% from the state on it, right? Mom and Grandma, or Grandma and Grandpa open them up. They got each one for each kid, right? Now all of a sudden we're not paying state tax on that. And so yes, it's complex in a sense from a servicing standpoint, right? That's why I get to work with an advisor, not by yourself, because our team can handle it, right? But that's exactly what we do, right? Is making sure we can maximize those deductions from that standpoint. Because I think it's ultra helpful, because that's 5% more you're giving the kids in a sense, right? You get the deduction, you have more to give back. So that was also very enlightening. So we take it in, take it out, because Kayla's only a rising junior. She's going in her junior year, but she started college classes now, and I can get the credit, right? Because I'm paying college classes. I can take the money out of the 529 plan. I mean, I'm going to end up with a 20. What was it? I don't even remember. We were like 4,600 or something like that in deduction. Nice. It's great. As we do this stuff, so a lot of planning in there, a lot of involvement. I think that was interesting. What to do with this money? Because if taxes are a problem, let's get it there. Lower the taxes. Get it tax deferral or tax free, right? Because moving an RMD is like almost doing Roth conversion, right? Within reason. So you're on long-term tax deferral. So. Anything else on that one? Because I'm getting hot. That pool's looking good.
I'm burning up a little bit.
Yeah. So, I think that's what we had for the week. I know that there's a series that you're coming up with. Megan's going to be doing with you guys. This series is, I get a little respite. You know what I mean? With some of the stuff with my schedule going on. So, anything you want to add about that one?
Megan and I are going to be talking a little bit about some tax advantage investments like opportunity zones, and also talking a little more about private investments in general and the capital stack for companies. So be on the lookout for that as well.
Yeah, I think that'll be absolutely helpful. I think, it's interesting. We've always kind of been an advocate for it. The investments have always, they've been, they're an investment, right? So some work out the way they're supposed to, some work out better than they're supposed to, some not as well as they're supposed to, right? But understand they're important. But as the market starts to diversify away, I think I might have mentioned this a couple weeks ago, when you start looking at Bloomberg, they're talking about the flow going into private investments. And if I remember reading something just recently in Financial Planning Magazine, the actual SEC has redefined what an accredited investor actually is. And so I think that's something I think you plan to add to that, is what the redefine of what that looks like. So it gives more people have access. Right? Because you know what? Just because you're worth $1 million making $300,000 a year does not mean that you're the right person for that investment, right? Or you're just not. So it's a lot more about your aptitude around the investments and how they get there. So I think it's important. I was just reading that, and I got to dive in a little bit more detail on it. But yeah, for the Financial Planning Magazine, they just released the idea of redefining what the accredited investor is. So I'm looking forward to seeing that myself. So, but I think otherwise than that, man, I'm gonna get in the water.
All right, me too.
All right. Well, thank you, everybody. We appreciate you. Pool's calling us, so we're going to get to that one. But please don't keep us a secret. If you know anybody else that we can help forward these videos, keep us at the top of the YouTube list. Keep us at the top of Google. Send these things off there. Send in your questions. Even the capital stack one, just so you know, that part of that series is coming from some of the questions that we've had from our clients that we appreciate. So keep it coming so we can build series. We can get you guys educated. Answer any questions that you have. With that being said, have a great summer. Have a lot more fun. We'll see you in the next couple weeks or so.
Sounds good.
Thanks, everybody.
Have a good weekend.
Bye.